Many people get this wrong when they first start to learn how to trade. That is starting at the bottom and the foundation of where technical analysis and charting began. So today we're going to be talking about one of my favorite classical charting setups, how to trade it, what it is, how it works, and how you can profit from it. Before we do that, I need you to hit that like button, subscribe, turn on post notifications, and I'll say it again. We are dropping a brand new flagship product here at Because Bitcoin within the next week. If you want to get early access to that, join the Discord with the link down below to gain early access to that product. You're not going to want to miss this, and this would be a game changer for all traders alike out there. Let's dive into it. So today we're going to be talking about falling wedges, or a wedge pattern in general, and how I use this to trade and how you could use it to trade. And many people get this wrong because they don't study these things anymore because they think they're outdated, or they think, they don't need to. For me, when I started trading and learning how to trade, I bought textbooks and I went through and I highlighted and I took notes. So I scanned a couple pictures out of this book here that we're going to get into. So you'll see some highlights and some annotations here. And that was me, a young Louie back in the day, learning the foundations of charting and technical analysis. So the title of this book, one of my go-tos, highly, highly recommend this book. This is not a shill. I have no ref link like that, but Technical Analysis and Stock Market Profits, the original Bible of technical analysis by Skalbacker. This was written in like the 1940s or something like that. 1930s, 1940s. But this book, if anyone asks me that or tells me they want to learn about charting and technical analysis, this is my first recommendation because it gives you a great foundation. Again, something a lot of these traders miss. So we're going to be talking about wedges today, and we're not going to read through all of this. You could screenshot these and save these. Maybe Ed can I could put a file together and put a link down below to some of these experts on this book, so you could save and come back to later. But we're going to be talking about falling wedges. So I'll read a couple blurbs here, and then we're going to go into some real life examples in the charts here. But the wedge reversal formation is produced by a progressive narrowing and price range, but without any great showing up of prevailing trend. What that means is price is ranging back and forth, but not giving really a true direction. It's just bouncing back and forth. But the spread between minor tops and bottoms grows less and less. So price is pinching more or less and getting tighter and squeezing. Somewhere near the theatrical tip or apex of the wedge, which is like the edge of the wedge, which we'll get into, prices break away from this formation or pattern with or without volume and increase during the direction. Thereafter, price accelerates and moves away faster from the prevailing chart pattern. Here it goes into, there are different types of wedges. There's rising wedges and falling wedges. Today, we're going to be talking about falling wedges, but you could use what you learned today and trade it the opposite way. I'm more of a long-sided trader. That's just where I specialize in. So obviously, I trade more falling wedges than I do rising wedges. And I think actually the hit rate on a falling wedge pattern is much higher than a rising wedge, because a lot of people can confuse a rising wedge with just a standard uptrend in markets. The boundaries of the wedge must be clearly defined and well filled with price action. The wedge must point sharply down or sharply up. A converging pattern which is projected on the chart in a nearly horizontal direction is more partake of a nature of a triangle or a range. So that's just a little excerpts that I highlighted, I guess, when I read through this book. We're going to get into a lot more of this in my own thoughts and stuff. And in this textbook, they give you charting examples. These are charts from back in the early 90s where technical analysis worked. It probably worked a lot better then than it does now. But these patterns still do work. And you can see a classic falling wedge example here that broke out and ended up going a lot higher, right? Where people mess up is they see a trend going down, right? No one wants to buy a chart that's doing this because it's going down. Oh, that's going down. I don't want to buy it. People only want to buy stuff when it's going up. But when it's going down, trading into an apex and has similar properties of a falling wedge, you could time the bottom or the breakout or the change of trend using these chart patterns and using these properties. So that is just a little excerpt from a textbook that I highly recommend to all of you. Check it out. Maybe we can put a link down below on Amazon or whatever. But I highly, highly recommend this book, guys. So visually, what was this book describing? I know I showed you a smaller example. It might have been hard to see. So a wedge, specifically a falling wedge. Price is coming out of a downtrend, right? However that may be. It finds a low, a pivot point low of some sort. Gives a strong bounce. Everybody gets excited, right? Oh, bottom's in, right? Bottom's in. Here we go. And begins a process of ranging in a way, but in a slight downtrend still. But price gets tighter and tighter into the apex, as the book mentioned, before breaking away from the formation and the trend. And it looks something like this. I know I didn't draw perfect here, but you should, not in all scenarios, but in most scenarios, again, trend lines are more price areas than an exact pinpoint location. But you get price ranging and ping-ponging back and forth. But over time, the bounces get smaller and smaller. Price gets tighter and tighter before eventually breaking the other way. Where in reality, most people in a chart that's looking like this, especially, let's say they tried to long here and they round tripped, and they try to chase this move, they get round tripped. They try to chase this move, they get round tripped. By the time anyone who was watching this chart way too closely, not giving his time to play out, by the time the real low is formed, whether it's a double bottom or they run the lows and get back inside the formation, most likely they've given up before the true breakout. But this is a great way to catch bottoms, especially on the higher time frame. But this can be used in any time frame. You could use wedges on lower time frames. You could use them on high time frames. And these are also continuation patterns, right? So this is an example of a bottoming falling wedge. Another example of a wedge is a continuation where price is in an uptrend. It begins to consolidate and pause. Everyone starts calling the top, right? And continues higher. This would be considered a falling wedge continuation pattern, right? So there are different ways to use these wedges, whether it's in a bottoming pattern or a continuation pattern. The thought process is the same. Smart money is accumulating at these low points of the formation, while dumb money chases and tries to buy the breakout at the highs and creates liquidity for the big money to bring price back down, trap liquidity, and continue to accumulate over time before getting fully positioned and letting price go the other way. That's really what's occurring here. So there are some visuals there. Hope that helps. Let's dive into some real examples of how these patterns play out. This is one that's kind of in the works here and is gearing up for possibly a true breakout here. Let me get rid of some of these drawings so it's a little more less distracting here. So this is Riot. Obviously, I'm going to use a Bitcoin related stock. This is Riot, a Bitcoin miner. But the range and the falling wedge that took place from 2023 up until just about last year is a textbook example. Of a falling wedge playing out to the upside, right? So again, as I mentioned, price makes a low or a bottom, gives a big bounce, and then begins to enter a multi-year consolidation, right? Sometimes these can take years to play out, especially if you're playing a high time frame swing trade, right? So this ping-ponged, making slight lower lows and slight lower highs for 2 years, right? But what you would look for is price getting into the apex. Statistically, if this is going to be a true falling wedge and not a chart that's just going to continue to do this and bleed down and to the right, you should be looking for a breakout, a healthy breakout on something like this, about 75% into the pattern, right? So this shouldn't continue to do this and then break out at the very end. I mean, it happens, right? There's no absolute. It's not an absolute science, but the healthiest of the wedge breakouts occur about 75% into the pattern, and usually after 3 or 4 touches on either the top or the bottom of the wedge. Minimum 2, right? Minimum 2 touches on both sides to give a clear defined wedge. A lot of the time you get 3 to 4. Another thing to note is that these falling wedges play out and have such a higher hit rate when you're trading and doing this consolidation into a demand level on the chart, right? So obviously Riot had a big run in 2021, big sell-off. We formed a bottoming base down here. We formed a bottoming base and ranged for about a year. This is now considered market structure or support. So when you get a wedge that is slow bleeding and trading into a big support level, right? This support level goes back many years, right? Not just here. You have tons of market support here, bear market support here. When you get these wedges and they are doing this slow bleed consolidation into a big demand level, the hit rate is much higher, right? When you're buying the lows of the wedge at your demand level, right? So you could have easily just traded this wedge. If you were better off if you just bought every time price came into this demand zone, you could have traded from wedge low to wedge high, right? And wedge high to wedge low. But eventually you want to trade the true breakout, right? So in this example, you got your one final capitulation lower for the 1, 2, 3, 4 for the 5th tap. You swept this low. You came into the lower extreme bearishness likely at the bottom tick of this wedge. And it's always going to be that way. When the market is most bearish, when sentiment is worst, that is when you're getting your extreme of emotion. And that is when you're likely entering a possible breakout scenario. So extreme bearishness at the lower extreme of the structure, a clean bounce from the structure low to the structure high. You saw a little bit of resistance at your structure high, but ultimately, bang, you get your true breakout of your wedge, right? So not everyone's going to be able to catch the low of a wedge, right? If you're tracking it and you like buying things low and you like buying things at demand, you could take a shot here. Or you wait for the breakout, right? So you're watching this wedge, you set a price alert, at or near this high or on this trend line here. And as price is breaking, whether it's here or here, and you bought into the stock, you were able to catch almost 100% move, right? If you were able to catch it at the low, you were able to catch a 300% move. So the riskier entry obviously leads to a higher reward, but harder, much harder of a hit rate on that. But this is a classic falling wedge example. Price ranging, ping-ponging into the apex, smart money buying at these lows and using dumb money as exit liquidity at the highs to accumulate a large position at or around the same area, which I mentioned would be a demand area, before eventually they got their final buys, they've fully positioned. We could let price go. We're not going to sell at the high of this structure anymore. We have our position. We want to make, hold this for the long term. And this is a perfect example, right, of these wedges, guys. Beautiful breakout. The target for any falling wedge pattern is always going to be the wedge high, which would be here. Put that in red. So your first measured move target, something else you learn in classical charting, a lot, these chart patterns have a great way of calculating a target. It's more of an area. It's not exact science again, but the target is always going to be your wedge high on the first breakout, right? So kind of exactly what played out here, right? We got the falling wedge breakout. We saw price accelerate faster once we got out of the wedge, breaking away from the structure, and we hit our wedge high target. Here, we also obviously underside, tag of this big resistance level, and has since pulled back. Right now, this would be a bullish throwback, right? So you get your breakout, you get your wedge high target hit. Great trade, awesome. You take profits at the wedge high. You would have been sitting greatly on that position if you sold up here at your target and didn't have to hold through all this chop. However, this is looking like a classic throwback, right? And a lot of times in classical charting, you get a breakout of structure, you get a throwback or a retest of that breakout structure, and then you get your real breakout move, right? So right now in this example, me and the Discord played this beautifully. We hit a multi 100% move on Riot on options. And now we're positioning again because we're throwing back. We're retesting structure. We're forming a macro high or low and now looking for the real breakout. So you could either simply accumulate at the lows of your wedge and hold through all this, right? If you have a longer term time horizon, or you could intra-trade it where you're buying the wedge high lows, selling the range highs, multiple times over, and then eventually trading the breakout of the wedge. So there's multiple different ways to trade this. And again, target one hit, pull back, bullish retest. You can now try to play this again for a continuation move higher, because a lot of the time, especially on the higher time frame, these falling wedges represent macro bottoms on several charts, right? So there's a great example of one that has played out in real time. I want to show you another example that could be playing out as we speak. And that is another Bitcoin miner, which is Mara. So you're seeing the similarities here already. Are you seeing kind of how this looks almost exactly like the chart we just looked at, except Riot did this already and is here. But yet Mara right now is coming off the lows of its wedge, right? Again, another one, multi-year falling wedge, ping-ponging, slightly lower lows, slightly higher highs into a demand level after forming a bottom, right? Again, most people look at this chart and say, boring, right? Down and to the right, I wouldn't touch that with a 10-foot pole. Me, I'm looking at this as a major opportunity to buy a stock at discount prices, because again, just as we saw with Riot, you're coming into 1, 2, 3, 4, your fifth tap, right? With 3 taps on the highs, 5 taps on the lows. You're testing major demand again, and you're getting a bullish reaction at the lower extreme of this falling wedge, right? So for me, this is getting close to being a breakout play where you go long and you trade this up into at least your wedge high. And then you see, does it break out or does it reject, right? In this example, from where you're at now, you're almost at a 2x just from here to the high, right? If you're buying spot or you're playing this on a longer term down at this level, this starts moving, you're sitting comfy, right? You don't have to worry about chasing the move back the other way. That catches most people off guard, right? And when it starts finding some resistance here, it needs some time to consolidate or break out. You don't got to worry about it. You're sitting pretty. But not everyone wants to trade or take the riskier entries if and when price trades back up into the high of this wedge and can break, right? Your last high in the wedge and break the down sloping resistance. You can trade the confirmed breakout of the wedge and go long on a move like that with a measured move target being the wedge high around $33. So you have a stock sitting at 11 with a high time frame potential falling wedge setup that could do 2 to 3x over a year or so. But this is a great example of one, and I'm kind of giving you guys. I've talked about this stock in the past. We're long this stock in the Discord for this specific reason: falling wedge, falling consolidation, major support level on the chart after coming off a multi-year bear market and ranging environment. Everyone's been chopped up in this range for the past 2 years, trying to probably play a reversal on this. They've given up. They're done. Big money has accumulated at these lows. They're likely done accumulating as we come in to about 75% of the apex of this falling wedge pattern. This is where we should start to see a reversal and start to see a true breakout. That's it, guys. That is how you play falling wedges. Again, these were 2 high time frame falling wedges. You could play these on the low time frame, right? These appear everywhere. Now that you've seen this video, I guarantee you're going to start noticing these falling wedge patterns as you trade, whether it's a bottoming formation or whether it's a continuation. I actually can show you an example of a continuation as well that could help you guys. Here's Tron, a high cap crypto or altcoin. Here's a great example of a falling wedge continuation, right? We just saw 2 examples that formed a low. Here's a great example of continuation where you have an uptrend. You pause. You begin your ping-ponging, bouncing off your lower extreme into demand, finds legs, breaks the wedge. If you simply played the wedge break, you're up on profit with the target of your wedge high. If you took the riskier entry, bought the last leg or touch of the wedge into your demand level, you're very much in profit, right? So another example of a falling wedge, but in a different context, using a continuation pattern. So these wedges are everywhere. They're super simple to trade. Anybody can do it. Anybody can draw these lines as well, guys. It's more or less controlling your emotions at the peaks and the troughs of these wedges, because at the highs of the wedges, everyone around you is going to be bullish and telling you to buy. And at the lows of the wedges, everyone is going to be telling you to sell, get out, it's going lower. And you have to be able to read through that, stay level-headed, and go against the herd, and be able to buy when others are fearful, and sell when others are bullish until the right environment presents itself for a breakout. So I hope you guys like this video. We're going to be doing more educational videos like this. If you liked it, let us know down below. Check out some of those pictures. I'm going to have them put a file of those pictures down below. You could save those, come back to them, use them as a resource. Again, check out that book that I mentioned in the beginning, and I will see you guys later. Peace.